A warm welcome to 2015's first episode of PolicyBazaar. I'm your host, Arjun Bhagat. And today we're going to talk about tax planning and how you can reduce the tax burden by choosing the right investment plans. But I would like to add that we are expanding the scope of the program to include home loans, credit cards, and other financials that you're looking to explore and get an understanding of. Now, coming back to the important subject of tax planning, and given that we have about 2 months for the financial year to end, well, it's ready now that you need to plan for it if you haven't already, as a good tax plan directly helps you achieve your financial goals. That's why we are demystifying tax saving instruments for you in this episode. And joining us on the show is Naveen Kukreja, Group Chief Marketing Officer of PolicyBazaar and Director of PolicyBazaar in our studio. Welcome to the show, Naveen. Before we get into the nitty-gritty of tax planning, and tell me about your philosophy of investments and insurance, and how do you look at the subject?
Thanks, Arjun, and hi everybody. So like you said, on the investment philosophy, as an individual, why do we earn? We earn to cover our expenses for today and to save for our future goals, which could be retirement goal, which could be goals for our child, goal for our family. And the investment philosophy is geared or linked with the goals that you have. And depending on the goals, you define what you want to achieve, what you want to have in terms of a corpus after a certain number of years, and what's the time period you are looking at. And that pretty much defines what are the right investment instruments that you must go for as an investor. That's a simple principle that I follow as an investor, and I recommend that the same.
Right. So tax planning, coming back to that subject, is very, very important. Yeah. We've got about 2 months. We've got Feb, March. A lot of our viewers would invest in these 2 months, and I don't blame them. There are a lot of financial commitments in the early part of the year. How do they look at tax planning now? How much can they save, and how would you go about it?
So, Arjun, saving is something that one must try and do all the time through the year rather than doing it towards the end of the year. Government has kind of devised these instruments and devised these policies to encourage people like us to save, and thereby government gives us tax benefits to try and save on the tax and kind of put money towards the future goals. So, like you said, there are 2 months to go for kind of still, if you haven't done the tax planning yet, 2 months to go and kind of save the tax. Given the benefits that the government offers now, which go up to as high as 1.5 lakhs of income can be tax exempt, you can save as much as 56,000 if you plan your investments well, and you can save the maximum tax. So I would encourage everyone to kind of look carefully, and we'll talk about some of those instruments today in the program, and try and save as much tax as possible and in the same process kind of save for the future goal. Okay,
so you mentioned the figure of saving 56,000 rupees. Now that's a substantial amount of money that you can invest if you have the right instruments to tax plan with. Yeah. Go through us step by step. I mean, how can someone save 56,000 rupees?
So there's a section called ATC wherein you can up to 1.5 lakhs of your income can be tax exempt. And if you're in the highest tax bracket, which is 30% plus, and if you kind of invest 1.5 lakhs, you end up saving more than 54,000, around 54 or 56,000 rupees as a pure tax that you save, which you otherwise would have had to pay. There are various instruments that are available in the section ATC. The most popular of them being PPF, something like PPF, which everybody is aware of. PPF of course had a cap of 1 lakh earlier, now has been increased to 1.5 lakh. So if you that's one of our very popular options that you save in PPF. You get a fixed return of 8.7%. It's kind of managed by government, so in that sense there is no risk in that. The process, if you already have an account, the process of investment is very easy. If you don't have an account, you can open it with post office, or now some banks offer it. So that's one of the popular instruments. One of the things that it lacks is that it doesn't link the investments to market, so you don't expect high gains. you expect a fixed gain of 8.7%, which is more or less close to the inflation.
Right, right.
Some of the other instruments which are linked to market are like unit-linked insurance plans, which are online. Now there are available online also. So Ulips is something that's not very well understood by consumers. However, in the last 1 year, there have been online Ulips which have been launched by insurance plans, which are now very popular.
Okay, so explain to us what a ULIP is, because earlier we were talking about the traditional way of investing, and the options have increased in the last 10 years.
Yeah.
So tell us what ULIPs are for those of us who are not really aware of them.
So ULIPs, if you as a consumer or as an investor, if you're aware of mutual funds, ULIP work very, very similar to a mutual fund. What it offers is, besides the investment option, it offers an added protection level. So for example, if you take a ULIP, you will typically have a cover of 10 times the premium that you're paying. They are very good plans now with the new products and with the new regulations from RDA. They have now become very good products.
So when you say a good product, what do you mean by that?
So
I mean that goes for any investment plan or instrument.
What I mean by that is that now with the new set of ULIPs that have come in, the charges that are charged from the consumers in terms of the annual charges for the
management
product,
charges,
the fund management charges,
right,
they have become very, very low. Some of the best ULIPs now charge as low as 1.2% of your as annual management charge.
I remember them being pretty high some time back.
They used to be pretty high. There were multiple charges that were being levied in the ULIPs that were there in 2010, 11 in that era. But now what's been there in the last 1.5 years, they have pretty lean charges. Some of the best ULIPs which are offered by either HDFC, Aviva, Aegon have very low charges. They actually in terms of charges are better than mutual funds. Plus they also offer you a sum assured of added protection cover, which
right,
you can go for. But the ULIPs essentially work really well if you have a very long time horizon, and if you want to save something regularly every year, then ULIPs work very well. A related option for consumers for saving tax and having equity exposure is something called ELSS, which is an equity linked savings scheme, which is essentially a mutual fund which is eligible for tax saving. Because they are eligible for tax saving, they have a lock-in period of 3 years, which a normal mutual fund doesn't have. But that's still one of the lowest lock-in periods compared to other tax-saving instruments. So either an ELSS or a ULIP can be very good options for consumers who are looking for really long-term horizon and are looking to have some kind of equity in their investment plan. So these are a couple of options on equity. Some of the other fixed income options are the standard ones like a bank tax saving deposits with the banks.
But the lock-in periods are more.
The lock-in periods would be 5 years. 5
right,
years for a tax saving deposit. The lock-in period for instruments are typically 5 years or longer. In a PPF, it's longer than 5 years.
Right.
ELSS in that sense has the lowest lock-in period. So if you have a bank account, you can just go to your bank, open a tax saving deposit. You will save tax on that for that particular year. However, when you are investing in one of these instruments, you also have to keep in mind that are the returns going to be tax free or are the returns taxable? I think we'll talk about more in later part of the episode.
Right.
Besides the bank deposit, one of the other popular avenues for saving tax is something called a voluntary provident fund.
Right.
That requires you to plan it in advance. So there's something that your company deducts, which is tax free for you. However, what you can do is you can add your contribution and and kind of deposit that with a provident fund account. That also gets about 9% of return, fixed return, and again a very good option if you do not want to have an exposure on equity side or don't understand that very well and want to invest in the fixed income instruments.
Right. So would you say that there are two ways of looking at tax planning? One is if you're looking at it from now, people have just 2 months to plan for this financial year. Would the strategy be different than if you're planning for the whole year? I mean, can you guide us through that?
So my advice to the investors is that plan in the beginning of the year rather than.
So this advice also holds for 2015-16.
For the next year,
right,
that starts from
right,
April, absolutely. So plan and plan for the goals that you have. So if you have a retirement goal, you are expecting a certain amount of income after your retirement, plan for that. Or if you have kids and you're planning for their education, plan for that. And if you plan well for those goals, what you need to do through the year and through the next few years will be fairly clear to you. However, if you haven't done that so far and you are kind of in January of 15 with 2 months to go, you should still kind of look at your goals and do a one-time investments within these 2 months in the instruments, depending on the time horizon. Like I said, if you have a longer than 5-year horizon, my recommendation usually is that you should go in for an equity, because equity usually tends to do better if for a time horizon longer than 5 years. And the equity options for you are either Ulip or an ELSS from a tax saving perspective. If you have a shorter than 5-year horizon or around 5-year kind of horizon and you have specific goals against that, and or you're not comfortable with equity at all, then you can go for the options that I said, like either a bank deposit or a PPF or a VPF.
So coming back to specifics, guide us through Section 80C and the tax instruments which are available for people to invest in and save.
Arjun, like I said, in 80C there are various options that the government has allowed for investment, whereby you can invest in long-term kind of investment and save tax on that. PPF, voluntary provident funds, are some of the popular.
So we're just reiterating the same thing for our viewers, because
a couple of other options which are there, like an infrastructure bond, which became very popular in about 2 years back, when they were they were available, and they could allow you to save tax over and above 80C. But now they have come into the fold of 80C. So infrastructure bond is another option. Companies would come out from time to time with long-term infrastructure bonds.
We haven't really seen that happen in this financial year as yet, have we?
Yeah, Arjun, they became very popular a couple of years back when government allowed tax saving over and above 80C, and that's why people,
about
20,000 more. And because people could save more tax by investing in these, they became very popular for a couple of years. But now, since in this year, they've come back into 80C. So that's one of the options. My suggestion is that you would be able to find options of investment within provident fund or with the bank deposits. Typically, the interest offers by the infra bonds would be similar. So unless you're very confident or something really good has come out, infra bond is not something that I would kind of recommend, because there are other options which are equally good and more popular.
What about health insurance? Because that's another area which offers you tax savings, and you can increase your limit by buying insurance for your parents as well.
Absolutely. Very rightly said, Arjun. So health insurance allows you to save tax in a separate section called 80D. However, the reason you buy health insurance is to protect your and your family's health and your parents' health. If you have bought health insurance for you and your spouse and your kids, you can save up to 15,000 of tax. And if you buy it for your dependent parents who are over 60, then you can save an additional 20,000 rupees of tax.
Naveen, what about for senior citizens and also the pension scheme that the government has? Can you enlighten us a little bit about that?
Arjun, right. So there is a senior citizen saving option that the government has come out with. It offers a higher return than PPF, so it offers 9.2% returns. So it's as the name suggests, available only for senior citizens, somebody who is 60 years and above, or somebody is 55 and above and has taken voluntary retirement. It's a good option for somebody who wants a senior citizen who doesn't want exposure to equity, and the time horizon is not high. It offers a higher than PPF return. So that's a good option for senior citizens. You mentioned about NPS, which again is a very good option if somebody can manage to open the account easily. That's not a very easy part of it, and the program is still kind of gaining popularity, although the program and the product per se are very good. So essentially what it does is it offers or it allows you to save towards your retirement. As the name suggests, it's a pension product. It has one of the lowest charge structures in the country amongst all products. It does allow.
This is run by the government.
This is run by the government, but they have allowed private fund managers. So they have allowed 6 fund managers and selected them to run the funds. So the government doesn't run your fund management. So you can be assured that a professional set of folks who manage the funds, who manage your funds, are running the plan, and the cost structure is also very low. It does have certain restrictions in the sense that once you invest into that, you cannot get your savings out till you are 60. So in that sense, you need to plan really long. and if you kind of need funds in the middle, it becomes slightly cumbersome. Also, when you turn 60, you can only take about 1/3 of that as a lump sum, and the remaining you have to invest in an income product, which is typically an annuity product. So despite those restrictions, it's one of very good long-term programs for the consumers. So I would suggest and encourage people to kind of look at that positively.
Right, Naveen, well, we have to take a short break, and when we come back, we're going to be talking about some of the issues that you have, some of the questions that you have sent to us, but tweet us at Twitter at PolicyBazaar_in. You can also email us, and we'll see you shortly after this break. Keep watching.